It's time now to look at each of the three sections in the cash flow statement one by one. In this video, I'm going to look at the first section and tell you how the cash flows from operating activities are calculated. I'm going to do that with the help of a set of financial statements. You see on the screen a balance sheet. You have all the terms that you are aware of. It is presented in the format that we know about as well. And I also have a profit and loss account, but not only profit and loss account, also there is a section on profit and loss appropriation. And you've seen this statement before as well. So using this, we are going to talk about the process which is used to arrive at cash flows from operating activities. Now let's look at this account. In this account, you have sales, purchases, direct expenses, a number of expenses and incomes are stated here. What is our goal? Our goal is to reach at cash operating profit. This statement gives you a profit. However, our goal is to reach at a cash operating profit during the year. In this statement, we have a gross profit number, a net profit number, and a final balance in the profit and loss account. We are trying to reach at cash operating profit during the year. You already know what is operating profit. Operating profit is equal to operating incomes minus operating expenses. But we are interested in cash operating profit. Therefore, you can use cash operating incomes and deduct from it the cash operating expenses, and you will have your cash operating income for the year, cash operating profit for the year. So I have a format here which we are going to use to re-prepare, to revise the existing statement and calculate cash operating profit. We are only going to take cash operating incomes and cash operating expenses and figure out our cash operating profit. So let us get started. Sales 1 lakhs, and so we're going to assume that these are cash sales, so 100,000, and then you have closing stock 40,000, so no issues with that. This is closing stock. On the other side, you have opening stock of 25,000. Opening stock is 25,000. You add to it the amount spent on purchases, which is 70,000. Then you have direct expenses. All direct expenses are operating expenses. Direct expenses. This is 18,000. And you have gross profit. So till now there seems to be no problem. It seems that all the items that we've picked are operating in nature. 27,000 is the profit, and you have 140,000 and 140,000 on the other side. There you go. So you start with the gross profit earned 27,000, and then you look at the rest of the expenses. Now you have indirect expenses. We are fine with indirect expenses, but there are two types of indirect expenses. These can be operating expenses or non-operating expenses. What are we looking for? We are looking for cash operating profit. We are not going to deduct non-operating expenses. Therefore, what is the portion of 10,000 which is operating in nature? Now it says there is a star here, there is a note. It includes operating and non-operating in ratio of 60 to 40. So operating expenses are 60% of 10,000, which is 6,000. So we are only going to write operating expenses. Operating expenses or indirect expenses which are operating 6,000. Alright. Then you have non-cash expenses. What are non-cash expenses? This is possibly the depreciation. We are interested in figuring out cash profit. So cash profit is going to be equal to cash incomes minus cash expenses. Depreciation is a non-cash expense. So we are going to ignore it. We are not going to write it in the new statement that we are preparing. Then you have provision for tax. Again, this provision means you are not paying the tax. You are setting money aside for the possible amount of tax. You have not yet paid it. So the bank account of the company has not gone down because of the payment of tax. So this provision for tax we are not going to include in the statement here. So ignore this. Then you have net profit balance. Our balance will be different. Let's look through the rest of items here. You have actual tax paid, which is 50,000. Provision is an estimation, that is amount set aside, but the actual tax paid is 50,000. So we'll go here and we will say tax paid 50,000. Oh, it should be 5,000 actually. Let me correct it. This is 5,000. So 5,000 is the actual tax paid. So this is how it works. At the end of the year, you calculate your profit and then you calculate a percentage tax according to the tax slab the company is in, or if there are any rebates the company is eligible for. So the tax liability estimation is done by the company, and then it is done by the income tax authorities as well. For large companies there can be more complicated issues. Some international transactions have happened, so determination of tax liability takes time, and typically it goes beyond a given financial period. So you have to close the accounts at the end of the financial year, so you have to deduct some tax. So what you do is you create a provision. You say possibly this is the amount of tax that we will need to pay, and that is what is the provision here. And then after the financial year ends, the tax liability is determined by the income tax authorities. There may be some back and forth there. After clarifications, it turns out that 5,000 has been paid as the tax. So we are interested in cash expenses, so we will actually use only 5,000, and this will give us our cash operating profit. Cash operating profit 27,000 and 27,000, and this balance comes out to be 11, so 16,000. So 16,000 is the actual cash and operating profit. On the other hand, we had 4,000 which was shown as the net profit earlier, and we have 16,000 as the cash operating profit here. After this, you have the section on profit and loss appropriation. In the appropriations, what do? You pay dividend to preference shares. Is this an operating activity? No, this is not an operating activity. This is actually money being paid to the share capital owners of the share capital, owners of the business. This is actually a financing activity. You are creating a provision for dividend again. This is also a financing activity. You are transferring money to general reserve. This is a non-cash transaction. You're not paying anybody right now, just saving money aside. Okay. So it turns out that from the next section there is no transaction which you should deduct from, which you should consider for this new account that we are preparing. On the we missed this one item, interest on financial investments, but again, as we know, this is investing activity. This is not an operating activity, so we will not consider this either. That's it. So during the year, the cash operating profit that was made is equal to 16,000. Now note that you do not actually prepare this account. I did this exercise to help you understand what is meant by cash operating profit. Alright. So if you were to prepare profit and loss account to figure out cash operating profit, this is how you would do it. But in practice, you do not prepare this statement. This is only for understanding. How do you prepare the statement then? The way to prepare the statement is as follows. You start with a bottoms up approach, that is by taking the net profit during the year, whatever is the profit that you make during the year, and then you make adjustments to it. If you remember, in one of the previous videos we looked at the cash flow statement of Reliance Industries, and we started with profit during the year, and then there were some adjustments which were being made. What are those adjustments? The adjustments are made to this profit figure. The adjustments are made for all the non-cash transactions, all the non-operating transactions. So we're going to start backwards. We're going to use the profit during the year, and we are going to make adjustments and then go upwards. Whatever had the expenses which were not required to be deducted will be added back to this profit, and the non-cash expenses will also be added back to the profit. The non-operating incomes will have to be deducted from the profit, and that's how you are going to reach the number for cash operating profit. So I will walk you through that as well. So same statement, I have it again for the next approach that we are going to take, and this is how we are going to approach this problem. We are going to look at the number of the profit during the year, profit made during the year, and then we are going to add to it the appropriations of profit. Why are we adding appropriation of profit? Because these are either non-cash or these are non-operating. The dividend which is paid is the non-operating item, and the reserve is the non-cash item. And we've seen here that you are taking some money out of the profit for the year. Profit for the year is 4,000. Profit retained during the year is 4,000, and out of that you are taking out this money. Profit made during the year is 3,000, not 4,000. The final number should be taken. So 7,000 and 10,000. Difference between these two, the amount transferred to the profit and loss account. The 4,000 was further used in paying these people. So 3,000 is the actual money, additional money that you transfer to the profit and loss account. So this is retained profit during the year is 3,000. So you are going to add to it, you're going to make adjustments for the appropriation of the profit. So the appropriations are here 1, 2 and 3. Three appropriations are given, which is preference dividend and equity dividend. So 600 for that. So dividend is 600, and this is to be added back because we have deducted it. Now we have to add it back. And transfer to general reserve is 400. This also is a non-cash item, so we add it back. So what do you get after this? You have 4,000. This is the amount of profit that you made during the year, correct? Here, this 4,000, out of the 4,000 you had deducted, you had appropriated 1,000. So we start with this 3,000 that finally was left with us, and then we add to it the two appropriations, 600 and 400, because these are not operating expenses and these are non-cash expenses. All right. Then you make adjustments. So this is the first section of adjustments. There is a second section of adjustments. We have now arrived, walking backwards from here. We have arrived here. We have crossed the first stage of walking backwards. Now we are at 4,000. Now we have to make adjustments for this, non-cash item, this non-cash and non-operating expenses and non-operating incomes. We have to adjust for these. So we are going to add non-cash expenses and non-operating expenses during the year. Now provision for tax made during the year, I said this is a non-cash item. You don't pay to anybody. So the provision that was made is 6,000. So we're going to add back the 6,000 because you're not paying this to anybody. Cash has not gone out. Please increase the profit by this amount. You have this money with you. Then you have depreciation. let us take depreciation. So let's assume this is the depreciation, non-cash expense. This is 8,000, and let me add this here. The other items that can exist which are non-cash in nature are preliminary expenses written off. What are preliminary expenses? Typically, when you start the business, before the start of the business, there are registration expenses, there are some other expenses which you have to do in order to, register the business, in order to set the business in place. Now, all these expenses are preliminary in the sense that they are done before the business is started, and the income tax laws allow that all the expenses done before the starting of the business can be treated as a long-term expense, as you treat the fixed assets, and then every year you can charge depreciation on these amounts, and these amounts can be large as well. So preliminary expenses are being written off. This is an amortization. This is similar to depreciation. So preliminary expenses are treated as a fixed asset because these are a lump sum amount done before the registration of the business, and now you can depreciate them over a period of time in the business. Okay. Then you have any interest that you pay on loan. This is the finance cost. Do we have any finance cost? We do not have. We haven't been given specifically a finance cost, but we do have in non-operating expenses, which are 40%. So we will take a look at that. Loss on sale of fixed asset is also a non-operating item. Discount on issue of shares, debentures is also a non-operating expense, or a finance expense basically. So this is a financial expense actually. This is also finance cost. Finance cost. Loss on sale of asset is actually an investing item. But again, when you have a loss, that's a non-cash item. You get money from the proceeds of the asset account, from the proceeds of the assets, but no cash is being lost actually in the sale of fixed asset. We'll talk more about it when we go to the investing activities. Okay, so according to these items here, now we have to look for non-operating, and all these are non-operating in nature. And we have been given some information that non-operating expenses are 40% of this amount. So 4,000 is the non-operating. So we'll club all of this and say 4,000, and we will assume that non-operating will include some finance cost and some whatever else, something which is not operating in nature. All right. So we've added it back. The third step is to now go to the credit side and then deduct non-operating revenues. We are looking for cash operating profit. We should not add any non-operating incomes. So we had an income of 1,000 which was non-operating in nature. This increases our profit. The 4,000 profit that we have, it includes 3,000 received from interest on financial investment, which we should not include. So interest earned is 1,000, and we should deduct it. Therefore, we're going to put it in the brackets. When we looked at the statement of Reliance Industries, I told you that the items in the bracket are the negative number. These are the outflows. So rather than putting a negative sign, we put a bracket sign. That's the format. And then if you had any profit on sale of fixed asset, you would also deduct that, because any profit on sale of asset will also be shown as an income on the credit side. So we don't have any such item. That's it. And then finally, you have tax that is actually paid. What is the tax actually paid? This is 5,000. Correction. 5,000 is the actual tax which is paid during the year. I'm going to write 5,000 and put a bracket around it to say that this is an outflow. Now all we need to do is to sum this up. There are things which need to be added and two items which need to be deducted, and we will have our operating cash profit. Ignore the rest of the statement. Operating cash profit, and we have to do this summation. So this comes out to be how much? This is 4,000, this is 10, 18, 22, minus 1, 21, 21 minus 5 is 16. So I have 16,000 as the cash operating profit. Now, this before working capital changes, this refers to the next set of calculations that we have to do, and I'll explain that in a minute. Right now, do not focus on that. Only focus on the objective on the slide, which was to calculate cash operating profit 16,000. We used the other approach earlier, wherein we prepared an account. Let's look at that account and say what is the cash operating profit. Well, there you go, 16,000. So if you prepare a new account and consider only the operating incomes and operating expenses, cash incomes and cash expenses, you get 16,000. We took an alternative approach where we went backwards. We started from the profit earned during the year, which was 3,000, and then added back the expenses which we should not have deducted, and deducted from it the incomes which we should not have added. All right, that may be a mouthful. So this is the process which is followed in practice, and we have seen this in the statement, the cash flow statement of the Reliance Industries Limited as well. Okay, so I'm going to stop here, and I'll do the second part of this discussion in the next video. In this video, the purpose was to calculate cash operating profit, and we've done that. In the next video, we are going to look at this rest of the statement. What are these working capital changes, and how do we make adjustment for the working capital changes? I'll see you in the next video.